Hey everyone, welcome. Web is here. We'll be starting in the next few minutes. We want to give some more time to people who are running late right now. Few more minutes, and we'll start the webinar. All right. See you in a bit. Hello, everyone. Again, this is Ron here. We're doing a lot of testing today, so we're trying to stream this event to YouTube. So if you are on YouTube or you're on a website and you're seeing a chat box, feel free to join in, say hi. I just want to make sure that everyone can hear me and everyone can see me. So if you can just type something or write something in the chat box, that would be great. And if everything works fine, we'll be able to get started. Let's give it a second. All right. Okay, so well, I'm very excited. Hello, Dan. How are you? All good, all working. Perfect, perfect. I encourage you very much to participate and say hi. Use the chat. Feel free to interrupt, and we'll try to answer all the questions as they come. So let me start off by having sharing my screen and start talking about what's in store for today. It's good, good. I see a lot of participation. Nice. Glenn is saying you get video unavailable. So if you see video unavailable, maybe try watching us on YouTube. It should be, and maybe that they'll stream it much more easily. So there's a lot of experimenting today. We're trying this as a new method of doing our webinars as live stream events. Next time, we'll try to stream it to Twitter or LinkedIn as well, and we'll see how it goes. All right, so without further ado, let's start. So today's webinar is part one of a two-part series on short squeeze strategies. Originally, it was we were planning on doing this as a one-off webinar, but we then realized that it may be better just to go over the basics, or not the basics, to go over the concepts of short squeeze strategy, how to identify them, how to exploit them, and then go into more details with more code example on the next part. Today I'm joined by Laurent Bernut. I hope I'm pronouncing it with the right with the right no, not as much. So let's say hello. Let's get him. Hello.
Hello, good morning from Tokyo.
Good morning from Tokyo. Yeah, what's the time over there right now? It's I know that I'm keeping you up very late.
Yeah, you woke me up like 15 minutes ago. It's 1 in the morning, so it's first thing of the morning.
Yeah, it's 5 o'clock somewhere.
It's fine.
Yeah, so Laurent is a long time short seller. He has a lot of experience in automated strategies, specifically on the short side, and we can have a little chat about the recent events in the market, and then start to maybe dive a bit more deeper as to what is a short squeeze, specifically what happened, how we can exploit it. How we can protect ourselves if we're on the short side, if we're on the long side. So let's start talking. So let's start maybe by covering this a quick agenda, which I just did. We're going to go over the theory versus practice of the short squeeze, and then we're going to cover two specific strategies that Laurent was kind enough to expose, which is the simplified squeeze box and the bandwagon. And then for those who are interested, I'm going to go over a little bit about the roadmap of Tradeologics and give you a quick update on where we're at right now and what we have in store for the future. So Laurent, why not start by introducing yourself? You've been a trader for how many years now? About a billion?
20.
20 years. So yeah, give us maybe a little bit of background how you started and your experience.
Oh, so I'm from New Caledonia. I was born in New Zealand, Wellington in New Zealand. Then I was adopted in New Caledonia, which is a French territory. It's like Tahiti, but better. Much better. So then I studied over there. Then I went to France, the mainland France. So I finally found snow at the tender age of 20. And I realized that coming from the South Hemisphere over there, it's winter for Christmas, which doesn't make any sense. Then I went to Japan. I think it was 1990, first time. Then 92, I studied in Japan, and I've been about 27 years in Japan altogether. I also passed the US CPA, and I was a Japanese accountant originally. So the funny thing is, like, people always say, "Oh, you don't understand fundamentals," and so on and so forth. And then turn around and say, "Could you please explain me this line about like the financial statements? I used to do Yuka Shoken, Koku Shoken, Santanshin, Iten Kakaku, and all that stuff. I'm not in practice anymore." And because of that, back in I think it was 2000, like when there was WorldCom and Enron and so on and so forth, people wanted a foreigner who could understand Japanese accounting principles. So this is how I joined the market. I joined on the sales side. Then in 2002, end of 2002, I was fired. Like one thing to remember for all the guys who like work on the market: if they fire the second time, the second round of layoff, put your bonus in the market. It's rallying. So I was fired literally 28 days before the last bottom tick of the market.
Good timing.
It was not too bad. Yeah, absolutely. And if I'd known that, I would have put my money. Well, I didn't have any money back then. So anyhow, then I joined a startup hedge fund. We started with 5 million. I think that now it's about 2 or 3 yards, somewhere like that. So I built a portfolio management system over there. Then everywhere I go, I usually do the same thing. In 2005, I switched hedge fund to do the same thing, do more quantitative stuff. And then in 2007, I thought the game was too easy. I mean, and I decided to dock at Fidelity, and also I met my boss, still very, very good friend. And I stayed there as a dedicated short seller. So the idea there, like, I mean, like picture this, like Japan, it was the longest bear market on record, and my job was to do worse than the worst bear market on
Worse
record.
than the worst, yeah.
Exactly. So the day after the apocalypse, I hope I can stumble upon a stash of côte rôtie like that, because the scorpion, the rats, and the ants, they're not really good for conversation. And all of us are going to be alive. It's not going to be easy. So anyhow, so then I did that for about 8 years. And in 2015, we parted ways. I decided to set up my own shop. It didn't go very, very well. So now, here we're in 2021. I do algorithmic trading strategies, long and short. I do primarily ETFs. I do four.
What made you start doing longs as well?
That's the funny thing. Like, when I went for interviews, people ask me like, okay, that stuff is so cute and nice on the short side, but can you do long? I'm like, can Rambo teach judo to a bunch of old grandmas? Come on, can Rambo be a mole cop? So, I mean, like long, short, tomato, potato. So, yes, it's true that
all tastes like chicken.
So, yeah, they all taste like chicken. Shorting based on fundamental is not scalable. So, I'm writing a book that's going to be published with PAX. It's going to come in June, end of June. And it's true that it's not scalable. Fundamental short selling, I've done that. As an accountant, I uncovered my fair share of scandals and accounting, creative accounting, but it's not scalable. I mean, for multiple reasons that we can go through. So as a dedicated short seller, why did I go through that? What I realized is when you do in the long short business, 99% of the energy is spent on the long side. And the remaining 1% is people want to find something that they want to find a structural short, something they can throw away the key. Now, if you think about it, I believe that it's a dereliction of duty. I have absolutely no beginning of sympathy for the charlatans who say, oh, yeah, I'm after a structural short, because they don't exist. Why do you spend so much time and energy on the easy side and expect the hard side to take care of itself? It doesn't work like that. It's cute in theory. In practice, it doesn't work. So now let's move to the next slide. And now we can explore.
Exactly. So in like a high level overview of what exactly is a short squeeze, just to get everyone on the same page before moving forward.
Yeah. I mistakenly opened.
Maybe slow down on the wine at 2 a.m.
1 a.m. 1 a.m.
1 a.m.
No, but I opened it. Tomorrow we're going to Amami Oshima, which is a paradise island. And I opened this one a couple of days ago, and I realized that, oh shit, it's an expensive one, so I thought we'll finish it.
You have to drink it.
So what is a short, and what is a? Let's go through the mechanics, and then I will go through the short squeeze. So short selling is basically, you have to locate the borrow in the jurisdiction where I operated. You have to locate the borrow. Before you can place a short, you have to locate the borrow. Make sure.
When you say locate the borrow, just to go one step back. We're talking about a short essentially is you borrow a stock that you don't have in order to sell it, and hopefully you're going to give it back when the price is lower. So that's your bet essentially.
You sell at 100, you borrow, you sell at 100, you expect it to go to 95 or 90 or whatever that is. It goes to 90 stock. You buy the stock back and give what you borrowed back to the lender.
So you owe a stock, you don't owe the dollar value of the stock. So no matter what it costs, exactly.
Make money on the difference. So for this, you need a stock lending desk. And now what happens is the short side works on it as its own rules. It's its own universe. And many people who come from the long side, they're very confused. So, for instance, we're going to talk probably about GameStop, but GameStop to me is a classic tourist trap. So
tourist trap. Okay.
Yeah. Yeah, we're going to talk about it. But the idea of a short squeeze, what happens is, and they all start the same way. Uh, First of all, you need something that is very highly shorted, very popular short. Now, what
Right.
happens when they're popular shorts is there's a class of investors called institutional investors. These guys have already left the building. The idea behind this is the information that is available to the short sellers is the exact information that is available to the long only guys. And they're not the long only guys. They're not exactly stupid either. They can realize that something's fishy, so they're going to exit the building. So what happens is basically you're going to have very high utilization because the borrow that we talked about, institutions own the stock long or ETF on the stock long, then they lend it out through lending program. Now, as these people exit the building, obviously the pool of stocks to be lent out decreases. And then
Right.
the only people left are stable shareholders, which are like the founders of the companies and so on and so forth, or like banks with their cross shareholdings or partners and so on and so forth, or retailers. Also, interactive brokers, TradeStation, and all the retailers, they have Nomura, Daiwa, and so on and so forth. They all have lending programs, but it's only fractional. It's a fraction of what the institution do. So
Okay.
what happens
So
there
let's say
is
that
when
I'm a short seller. I borrowed a stock when it was 100. I'm selling it to someone else at 100, and now my bet is that the price will go down. But if the price goes up, then I'm obviously starting to lose. Now it gets to a certain point where I'm losing too much that I'm either my stop is hit or the broker decide to liquidate my position.
okay.
Right?
So the brokers, I mean, the broker liquidating your position happens in two cases. Number one, I mean, at least in the jurisdiction where I worked, is when you go out short, when you go out naked short. So naked short is basically you sell a stock without having locating the borrow.
Right.
So technically, it's not illegal, but if you do that too often, the federales are going to come and establish base camp in your meeting room. So this is not something you want, and your prime broker is going to tell you the law.
Right.
So you don't want to do that too often. That's number one. And number two, they would close you when you have a margin call. So
Right.
and so margin call is
Which will
basically
only feed the price even higher, which will only drive the price even higher because now I'm forced to buying it at a higher and higher and higher price, just kind of drives the price even higher. So I'm creating kind of my own momentum vortex, which I'm kind of sucked into.
which is something that is very important when people sell short. One of the key differences that you have with liquidity is when the key differences is the liquidity going in and the liquidity going out. So what happens is, for instance, when you go long, as it becomes more popular, more people participate, and then there's the volume increases. On the short side, it's the other way around. The volume decreases. Once people get a beating, they don't show up for round two.
Mhm.
So the volume decreases. So the classic tourist trap is to take a big position, and then as the volume is thinning, you realize that, oh, if you move out, you go, and it happened to me. So I talk out of experience here. I've been there
Yeah.
before, where you have like a few $1,000,000 position, and then there's a short squeeze, and you can't move because the minute you move, you're going to have market impact, and then if you have market impact, it's going to push it up. Then it's going to trigger somebody else's stop loss. Then it's going to trigger yours as well, and so on and so forth. So you have to sit through the storm. So the way to look at the short is actually through position sizing. It's not a stock picking exercise. It's a risk management and position sizing exercise. Think of it as on the way out.
Right.
You're going to have market impact. It's going to hurt on the way out, but it's still better than just sitting through. Now, how a short squeeze works, the mechanics of it is actually very, I mean, back in 2007, I developed this thing called the squeeze box. So the logic behind it,
We'll go to in the squeeze box in a minute. I just want to get a question here that Nick Start 210 asks. So let's see if I can. Does this thing work? Oh, yeah, that's nice. So Nick essentially asked, how could professional traders short GME so much when they knew that a squeeze was likely, even without Reddit interface interference? So what drove them to short GME so much? I can probably understand the first one who got shorted. I mean, the company didn't look right to them. That's fine, but they started to get more and more short positions. So where's the responsibility there?
Okay. So the idea there is it's like marriage. You can either be right or you can stay married. And in the market, you can either be right or you can make money. And people are too enamored. They're too infatuated with their desire to be right. So
Yeah.
this is the problem with these is that once the institutionals have left, this kind of structural or very crowded short, it's a binary outcome. Either it goes bust, either there's a corporate event, and the corporate event can be either a merger, it can be a short squeeze, it can be anything that tilts the supply demand, what is called the selling pressure up. So once the selling pressure is exhausted, and it's also a self-fulfilling prophecy. A lot of people talk about the positions they have. It's called reverse broking. So, for instance, let's say I short something, then I'm going to tell my broker, who's going to tell his client, and oh yeah, this is a smart guy. I mean, not in my case. Oh, this is dumb dude over there who does that, and there's a lot of replication. And then you can see the replication via Bloomberg or, for instance, Data Explorer. Oh man, it shows my age. Market, they call it these days. You can actually see the trades of other people. I mean, you can see their large positions. There's a lot of replication, and the news flow is bad. And those kind of credit shorts, they fall into the category that I call a structural short. Like everything's bad. The fundamentals are bad. Managements are not very pretty. The news flow is bad. Earnings momentum, yada yada. You name it. So it's a checkbox. But remember that every check has a price tick.
So it started with a good conviction and a good opinion, very rationalized opinion as to why go short. Then they have added the greed, and then they've added ego, something like that. Yeah. All right.
And then before you know it, everybody's selling. Now the problem with this is that when everybody's selling, at some point the selling pressure is exhausted. So all it takes is somebody caught in the sale, and that thing will cross the Atlantic.
And that's exactly what happened. That's exactly what happened. As soon as people started buying, and let's face it, the first buying wave that came out of Reddit wasn't that big. It started to move some stocks, but as soon as this happened, since the short interest was so high, it started to capitulate from there.
Also, what happens when you're short, you start to realize that, for instance, what is called utilization. Now, utilization is the ratio that I use the most. Utilization, on the numerator, you have the borrow that is being taken out, so that's the demand, and on the denominator you have the supply, the available for borrow. So when this one crosses over 50%, it means that there are more people willing to short than there are people willing to land. And when it crosses at 100%, or like in this case, it was 100%, or sometimes when it reaches 80%, you have something that is called callable borrow. Now, there are two types of callable borrow. One is like fixed date. Lorenzo, se llama short utilization. Se puede encontrar en Interactive Brokers or anywhere. It's called short utilization. Yeah, I mean, yeah, I see a guy with a Spanish name.
Yeah, we're gonna go deeper a bit more. So tell me something. What would be the main difference in between a short squeeze and a breakout? So how can you identify both of them? And because in both cases, essentially, what happens is that at some point it starts to take off. So maybe I'll just jump to that. To that slide, and then we'll go back, because that's kind of the answer that I popped to my head right now.
First, I would like to explain what is called general collateral, GC, and then the hard to locate, and then the callable, because this is important in the mechanics of a short squeeze. So the general collateral is something that you pay between 30 basis points to, I would say, 50 to 60 if you're a retailer. So that's the
Right.
standard stuff. This is the run of the mill. Then the hard to locate, this is when the borrow crosses between 40% of utilization to 60. That becomes a bit more difficult. So there are blocks here and there, and you can see the what's called the lending fee or the borrowing fee rising. And then the callable is when you've exhausted what is called the inventory. And then the callable, there are two types. One is fixed date, like in 3 months and so on and so forth, so you know when it's coming. And the other one is ad nutum. Ad nutum is anytime. So, for instance, there was a guy who used to do that, very nasty lender, who used to lend to flood the market with borrow, and then he used to pick it up. So, of course, he would
All
drive
right.
short squeeze because everybody would scramble to cover. You're forced to locate. You don't find anything. All right, you got to cover. So this is why shorting stuff that has very high utilization you might be right, but the guy next to you doesn't have the same risk management, but you're on the same stock. So you're basically driving down the same highway with a bunch of drunken fools who are going to go off the rails. And of course, you're going to get hurt. You're asking for it.
All
So
right.
the main thing is, as soon as you see the utilization rising above 50%, it doesn't matter. You might be right, but this is not a fight you want to pick.
All right.
You don't want to be the last guy in the bar at 3 a.m. Trust me, been there, done that.
All right.
So let's move on to the theory versus practice. So
Yeah.
there are 3 strategies in life. What? There's death,
Let me go back.
taxes, somewhere in between there are short squeezes. So you're gonna get a short squeeze. Now the Aikido short squeeze, and this is something that plagued me for years until I finally dawned upon my drunken stupor how to trade them. Because what happens with a lot of people who come on from the long side, they trade breakouts, right? Okay, it breaks out. Thank you very much. Let's do the bandwagon and let's jump on it. Fine.
Yeah.
On the short side, when it breaks down, remember that 95% of the people who are in the market, they're in to buy. They're not there to sell. They're in to buy. So what you see as an opportunity to short is a buy on weakness for a lot of people. Mm-hmm. So the idea there is if you short breakdown, more often than not, at some point you're going to find a squeeze that is going to rally past your entry point. It's going to force you to cover. So if you don't have good risk management, this is not going to be pretty. You're going to be forced to cover. It's going to push the prices up and so on and so forth. It's going to snowball. So the way
for that, I understand that short squeezes are relatively a short-lived event. Violent, but short-lived.
They're very unpleasant and they don't last long. But you know what? At the end of the day, you're forced to cover. And so on and so forth.
And then, the price rallies back. Yeah. All right.
So the first thing to do is make sure that you're not on the long side of those potential short squeeze. And the simplest way to look at it is to look for short utilization. Every time you see the short utilization above 50%, it doesn't matter. There are many stocks across the market, so you can find the next one. Don't worry about it. You don't have to be right on this one. That's number one. Number two is liquidity. So, for instance, there's stuff like Tesla, for instance, that has a utilization of 100%. But Tesla is liquid like 2 weeks of holidays in a country with spicy food and bad tap water. So, this thing is as liquid as it gets. So, you're not going to move the price.
It doesn't matter. All right. So if Tesla with the current position were small cap with less liquidity, then you expect the stock to be in a short squeeze. It's at some point in the near future.
So I should have not written this point about low institutional ownership, because this is really the thing that the glue that holds it together. And if people understand how it works, then people will definitely be able to replicate this. Institutional ownership, what it means is, you see, investors are fickle. So everybody's an investor until they lose 20%. So it means that a lot of institutional investors, they will stay in the stock, but as soon as they see a loss, they'll start to exit. Or when it underperforms, there'll be pressure to exit. So it's not because something is underperforming or heavily shorted that it will be squeezed. But when there's very low participation of institutional investors, it means that the selling pressure will be exhausted very quickly. As the short sellers make money on riding the tail of institutional investors. So once these guys are gone, then there's
Right.
nobody left to. So this is an
The,
important thing.
the rationale is that they hold the most stock long position. So that, yeah.
Exactly. So, for instance, I always made money like riding their tail, and the way to see that is basically going back to the utilization. And then the classic crowded short. So, I mean, you can go on YouTube now, you type GameStop or whatever that is, and you can see hundreds of those guys. So before the webinar, I went on YouTube and searched about GameStop because it's something that really troubled me. And to be frank, I've not been able to come up with an answer that was satisfying because people say that it were more short than the outstanding, and in the jurisdiction where I operated, it's not possible because we have to look at the borrow. So I wondered how it could happen, and frankly, I have not managed to find a satisfying answer. The
Mhm.
only almost satisfying answer was from Patrick Boyle. He's a hedge fund manager in London, and apparently the borrow can be re-lent, which is something that is completely foreign to me. There's no registrar, so it's completely foreign. I can understand when there's a complex structure like options where
Yeah.
there's delta hedging, and then you're at the out of the money, which floods the. So there are two things as well. One is the outstanding, and one is the float. What is the outstanding float is basically all the shares are in circulation, and then the second one is the outstanding borrow, which is a much narrower subset, which
Yeah.
is usually 10%. And this one being overflowed, that happens. But more than the overall float, I've never seen that. It may happen, but I couldn't understand. As far as GameStop is concerned, my sentiment on this is that the people who orchestrate behind that are extremely sophisticated. They're very, very, very because for me this is not new. This is a game I've seen played over and over and over again. But these guys are artists at manipulating social media because this is the classic prop shop or small hedge funds dissipating rumors. I've seen this over and over, but played like this, it's fine art.
Yeah.
My hats to the people who did that, and I stumbled upon an old dude who's like, yeah, it's gonna end in tears. Like I was thinking, yeah, yours.
Yeah. No,
So
everything that
please,
happened, my 2 cents on the whole Reddit thing is, if you look at the news media, you see that usually the traders over at Reddit are getting treated as like, this youthful, acting stupidly, acting irrationally, and I don't know. I think that they either know very well what they're doing, or they're in such position and a place in their life where why not go all in on something that may or may not work. So yeah. I mean, if I were I don't know, 20 something, still living with my parents, I wouldn't mind risking a lot of money because what's the worst that could happen? I'll keep living with them for another few months. So that's a completely different situation when you're older and have more responsibilities and more, you have family, and you have a mortgage. So it's a different type of thing. So I think the mixture of those two things, of people who are kind of the whole YOLO mentality, and alongside with people who really know what they're doing, kind of fueling everything. I think that what caused the craziness that we saw with GME. But that's, yeah,
yeah.
that's
mean,
just one man's opinion.
yeah. I mean, we'll never know. We'll never know. I mean, there was one couple of guys who. I mean, most of it is obviously the guys. A lot of it, the guys don't know what they're doing. Is just hopping on.
Yeah,
But there were a couple of guys who like it was unusual sophistication. Like the stuff that took me. I mean, Some of it is like, yeah, no, I wouldn't do it this way, but I realize, whoa, dude, this level of sophistication, you don't get it being a retailer.
Yeah.
So somebody's behind it. I don't know who that is. And if you look at the volume, it's consistent with the volume that is traded. I mean, like millions and millions. Like whoa. I mean, it might be like one dude in his basement between video games, like with his one share, but millions and millions and millions and millions. Like, whoa! So that's amazing.
Yeah.
But anyhow, that's something else. This is not my forte. This is not what I do. Now, the theory versus practice.
Yeah, let's start getting into the meat of thing on how you trade a short squeeze event. All right.
Okay.
Obviously, read my book is kind of what caught my eyes, and I'm looking forward for your book. But until the book is published, what should one do if we want to use a short squeeze event? All right, so let's kind of take a look at the telltale signs of that a squeeze short is coming.
Okay, so first things first, the high utilization. Short interest is probably not the one I would be looking for, but the high utilization or the very high rate, the sky high rate, tells us that the sky high rate, though, there might be some complex capital structure. So I will not elaborate much on it, but complex capital structure is where, for instance, there's CBs, there's mezzanine, there's warrant outstandings and stuff like this, project financing kind of stuff. That's a bit different. Or like there's very tightly held corporations. So this is a bit different. But if you're looking for high short utilization, 9 times out of 10, you're going to land on the guys that, okay, these are the usual suspects.
All right.
So the high utilization is like, I would say, again, let me repeat this, is the shares that have been taken off for short selling divided by the shares that are available for borrow, right?
Okay.
So when the 70 and above, this is very heavily shorted. So that's the number one. The number two is you want to look for something that is, I mean, the one that I used back in the days that I dismantled, and it was like Hellboy, like I dismantled and scatter the pieces across the realm to the four corners of the realm, because it hurt my friend. Like I remember, I was in a bar and I said, "Oh man," and he was lamenting about a stock. Like, "Oh dude, I was on the other side of the trade." And then he lamented, and I asked him about another one, Takefuji. How about it? No, damn, I was on the other side of the trade. But the idea is you want to look for some I will give you two type of strategies. One is more for institutional size, and the other one is more for retail size. So the institutional is when you see something that is deeply oversold, where the RSI has tanked, it means that the selling pressure is off, like completely exhausted. Then all it takes is a little bit of buying pressure to trigger a whole bunch of stop losses. What's going to happen then is if you buy and it's not very complicated. I used to run around my shop and, hey, Nick, can you drop me a 500 on this one? Or I went to, hey, Eric, this one. Oh, Peter, I found a good one for you. So anyhow, so drop 500,000 on something that trades about 2 million a day, and then immediately, because the selling pressure has been exhausted, the price is gonna tilt up. So it
really,
tilts up
that little 5,000 on the 2 million?
No, 500 on the 2 million. So if you like 10 or 15% of the daily flow,
right, okay, yeah,
it will immediately lift the price by 2, 3, 4%. So this will trigger the first set of stop losses. Then once this happens, people will be forced to cover. Then it will trigger the second, and then there'll be the broader number of people who. And then, oh shit, it goes up. So, all right, I need to do something about it.
It's time to get out the position. And in order to get out the position, I have to buy the stocks. And yeah, it keeps on going. Is there a way to track, by the way, is there a way to track the short interest? Because you wrote here that identifying the short squeeze, one of the things is to that you have high short interest. And the short interest is essentially the interest that you pay when borrowing a stock. Now, the less stocks that are available, the higher the interest is going to be, right? Is there a way to
Yes.
track? Is there a way to track this this number? Is this number really available, or do you have to try and shorten the and see what it's going to cost you?
So on a interactive broker, for instance, now I use interactive brokers. I mean, when you use Bloomberg, it's readily available, and there's a
Right.
service called Mark that sells it for professional. It used to be called Data Explorer, and they're the gold standard. Only I think Goldman and Morgan do not subscribe. They might subscribe to market these days.
All right.
But otherwise, on interactive broker, I've not managed to download it off the API, the Python API, but I can look it up on the screen. And surprise, surprise, a lot of the longs that I have now, they have a utilization of 100%. And but anyhow, so this so it's available. It's a field that you need to look up if you look at usually the tabs on Borrow. Now I don't know if they're readily available for download, and if you can download historical data. I don't think it's that easy. I've not been able to, so I'm not really smart, and I'm not really tech savvy.
Yeah.
So it's
All right.
but if it's available, I would love to know. I would actually love to know, because this is really the kind of information that is really, really helpful. It gives color on the stock. What we call color.
It's available, and and it will be integrated next month as part of our platform as well. All right. So let's start. I knew you're going to be happy about that. All right, so let's start with the first strategy, and then take a look at the second one. So this is the simplified squeeze box, and this is a strategy for going long, I'm guessing, right?
Yes. So the
Okay.
thing is, as soon as you see utilization rising above 50, 60%, don't bother staying short. You're asking trouble. So, so the first screening is like, okay, you need to screen out you need to narrow down within the entire universe the stocks that you're going to be targeting. So
Right.
the best way to do it is all the stuff that has very high borrowed utilization. And so that's the first step. The second step is you're going to also narrow it down to small and mid cap.
Yeah. All right. To avoid what you mentioned earlier about Tesla.
Exactly. Yeah. So now that this is your universe, now that once you've done the universe, then you need to have a setup, and then an entry, and then an exit. The difference between all these conditions is, think of it as a funnel.
Yeah.
So the setup is like the selling pressure exhaustion. So, I mean, there's not a short squeeze around every corner. Like, for instance, at the moment the market has gone up, so there might be some squeeze in progress, but you're not going to find the new next squeeze now.
All right.
The onset of a squeeze when you're when you're moving institutional money is when the market's down. When the market is really brutalized, really brutalized.
Okay.
When
So a small mid cap with high borrowing fee, short utilization, and RSI is telling us that it's oversold. What's the next step? What's a big puke day?
Okay, so once you have a big puke day, a big capitulation, it happens every now and then. Like, it's usually every 4 months or something like that. When you see it pukes, and you can see the volume on the day, that is like everybody that they throw the
Everybody's selling.
Everybody's selling. Now, if the next day it opens up, and it can puke for various reasons, or it doesn't even need a reason, but it's just like big the elevator down. And if the next day goes up, get in. Stop loss at the lowest low, or a little below that. A little below that. I always put like a little margin, because sometimes it gets retested, especially these days with a lot of HFT trying to nimble away. And so you put a stop loss a little below, and if it opens up, if it continues to go down, then don't bother. Don't bother. If it opens up, it means, okay, all the selling pressure is gone. Now this is the time I'm going to fart in the sail and push that thing all the way across the Atlantic.
Okay. So after a big down day, with the RSI and everything that you mentioned, if there's a move up, it means that it has started, essentially. It is the squeeze is started, and it's
Exactly.
the market is going to reverse.
Market is going to reverse. It's if you come with a big money where you want to scale up.
Okay.
And then you just drop this like 1 hour after the open or something like this. And then the way to trade those things, because getting in is not the most difficult part, it's the getting out that gets really tricky. So what and it took me a long time to find this one out. The idea there is most people tend to pile up. Oh, let me add some more. Let me add some more. Let me add some more. The problem with this is that it's very stressful. And you can ask the guys like who there was a guy, I saw a guy on a treadmill like, how do you manage the stress doing that? That's a very good question. And he obviously hasn't found the answer. But the idea there is to scale out. So in my case, once it starts to go, then it's very easy to sell because everybody's forced to buy. So you get filled in like 5 minutes. And
All right.
being set, like at 1 hour, 1.5 hour, 2 hours, start to unload the position a little bit and then let the remainder go. So the way I did it back in the days is I put a stop loss at the low of the third day prior, because again, those events, not the events like GameStop and whatnot, but those events like short squeeze, they don't last forever. They last for maybe like I would say between 3 days or 5 days to maximum 10 days, something like this. So 3 days, and as the stock starts to move up, you will see that it go parabolic, and at some point, okay, done, gently taken out. And these were very simple, and it was very, very effective tool. So that tool works. Look for the capitulation. You might not find a lot throughout the year. You might find, I would say, 5, 10, somewhere like this. It depends on the size of the market you're trading. It depends on the nature of the market you're trading. It depends on the overall regime. But this is not something that you can show up every day and expect to find one. These events are few and far between, but they do happen if you look at the broader, smaller cap. Because the thing also is that a lot of people love to short stories. People who short stories, what I call tourists, they don't care about utilization. They don't care about the quality of the borrow. They just care about the story. And this is where you make your money.
All right. So that's the simplified squeeze box. I'm afraid to ask why is it simplified and what's the what's the more advanced version of it. But let's just leave it at that, because I think that's there's enough stuff to play around to play with here. Another strategy that that you sent me about for handling short squeeze events is the bandwagon. Right?
Awesome, man! I've been on trains like that. In the Rajasthan. Oh yeah!
So that's the bandwagon, right? And that's essentially another strategy to go in long.
Of course. And then if you want to, I can explain strategies to go short, because this is the way I enter shorts. So we can actually talk about it. But this one is very simple. This one is the GameStop kind of guys. There's a short squeezing process. Just hop on the bandwagon. Now, the one prior is the one that triggers the short squeeze.
Right.
So this is the one that gets it going, and this one is when the choo-choo is going. So for this one, you need wider stop and smaller position size, because this is a rough ride. This is a rough ride.
So this is you're getting in while the short squeeze is already in motion and stocks is already gone up. You never know when the reversal is going to happen, so you need to be careful.
Correct. But the good news is that they're very easy to identify. Like the stocks moving like 3-4%. You look at the one way to find them is to look at the intraday RSI, for instance. This thing is like stays overbought forever. So
all right,
it tells you that there's no selling pressure. But again, like for these, you can't trade them in big size. I wouldn't. Now, these are. I'm glad you mentioned these are long strategies because I use, and this is the Aikido of short selling, uh, the Aikido of short squeeze. What happens is like short squeeze, they have a lot of momentum and they take everybody in their wake. Like all the bad short sellers, they're all flushed out. So
Yep.
what happens after, like, and it happened to me so many times that I can't even count. What happens after that is once everybody's flushed out, nobody comes out for round two. So what happens is all of a sudden you have all this borrow that is available. The borrow becomes affordable. You know that the buying pressure is gone because the short squeeze is exhausted. You know when it starts to roll over, this
Yeah.
is when you enter a short. This is the best time when you enter a short. So there are rules around it. Is basically when the dominant trend is still down and this thing rolls over. Okay, that is a very good entry. Why is that? Because you have an objective stop loss at the peak of the when it has rolled over. So you have an objective stop loss at the peak, and the dominant trend is still going down, and you know that all the tourists have been flushed out. So this gives you a good entry, and this is how I to this day, this is how I enter my shorts, and on the long side, this is how I enter my longs. So I buy the strong trends on weakness, and I short on strength. Make sense?
Makes sense. Makes sense. All
All right.
right. So that's actually that's very interesting because with your picturesque language and descriptions, it's kind of make it very at least for me, and we'll take a few questions in a bit. But at least for me, it makes it very straightforward to know how to look for in a quantitative and a qualitative way how to look for and detect short squeeze events. So there are very specific and very precise rules that I can identify where short squeeze is going to happen, and then I can take protective measures if I'm in a short position, or just jump on the bandwagon if I want to go long. So that's So that's a very interesting concept. All right. If anyone, by the way, have any questions about that, I'm gonna keep Laurent here for more Q&A. So if anyone has a questions, feel free to type it in, and we'll put you on screen. Here's one from John. Where's my cursor? So here's one from John. He asks the following questions. How can there be such a high short interest without pushing the stock borrow rate to such hard to borrow levels that it becomes unfeasible to be short?
All right. So first of all, I mean, you'd be surprised. It's a business. There was a hedge fund that specialized in taking out borrow of hard to locate stocks, and they literally lived on the fees because some of them would reach lending fees of 30%. There's no way. There's no way you're gonna make money on it. But
Borrow fees
some people
30%.
30% per annum. Yeah, I remember like there was
Wow.
like for instance, back in the days in Japan, like the consumer finance, I was literally one of the very first ones. I shorted those stocks when they were general collateral. I can tell you the story. It's hilarious. It's straight out. It's a Buster Keaton kind of a story. Once I was at Lehman Brothers and the Takefuji guys were there, and I hear like a tung, 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 tung. It just slams the door, and it was a big love fest between all the hedge fund dudes and Takefuji Consumer Finance, and the stock went down like 95%. And I walked out of the meeting and I called my boss, said, Peter, we got to short those ones. Why? The fundamentals are so good. I don't know. But it's a fucking love fest in there. Everybody's high fiving one another. They're all loaded. The only thing that this space can go is down. So we started shorting the shit out of it. And sorry for my French. It comes with a passport. And so we started shorting those. But then like 6 months down the road, it started to dawn upon everybody that, oh, this change was more structural. And the borrow was very hard to locate. And these things were like shorted at 90%. And at some point, I inquired for the borrowing rate, it was 18%. Imagine you're sitting on the other side, you're just collecting that. I told my boss we should buy those stocks. We should buy those stocks. 18%. We should buy them.
Right.
Just collect.
Just to lend them out.
Just to lend them out. And there are some hedge funds there whose job is to do that. So
Right.
don't worry, there's always going to be somebody who will take your borrow at whatever
Right.
price, because they want to be right.
So you can always, it's amazing that there's always a business to be carved in any small niche. So there are entire businesses that are just in it to buy stock for in order to lend them. That's fascinating. All right. So I want to talk about what we're going to do on the next part, which would probably be sometime next week. I'll send you obviously an email about that. On part 2, we're going to essentially take those 2 strategies that Laurent mentioned here, and we're going to go step by step and code a working strategy. We're going to use Jupyter Notebook to go through the entire code and all the calculations and the data feeds that we're using to get together type of information. And we'll go over everything, and from the research phase to the screening phase, and then we'll end up with a pure TradeLogix strategy code. Obviously, this is something that you can run anywhere. I'm just going to run the demos and show how to run it on TradeLogix, obviously. Yeah, so if anyone here wants to follow up and join us on the next part, be sure to keep an eye on your inbox for another invite. By the way, speaking of TradeLogix code, I want to give you a quick update as to where we're at right now. Yay! Thanks. I agree. I agree. It's definitely going to be an awesome part 2.
Black Gloves, how you doing, my friends? Good to see you.
Let's take another questions. 1 second. What's that? You mentioned incorporating high borrowing fees into the algo. Where do you pull the data from? Yeah, so what we did, there are a few data sources. I'm sorry, I'm not going to try to pronounce your name. I'm definitely going to pronounce it wrong. Sorry about that. Yeah, so there are several things. You mentioned that you're using interactive brokers to get those borrowing fees. The trick is to get the historical fees for that. And what we did is, specifically with TradeLogix, we partnered with data brokers that have that type of information, and so this data will be available specifically. If you wanna use it, you'll be able to just pull it just like any other time series type of data. So it's going to be every day you're going to get the percentage of the borrowing fee. So it's going to be very easy to calculate it. All right. Quickly about, just want to go over the roadmap. So as you know, with TradeLogix, we're developing the cloud platform for traders. Essentially, we want to take care of everything that is trade ops. I've always kind of joked about that when I started kind of getting into trading and the trading universe. I come from a background in ed tech, essentially a whole lot of math and statistics in order to serve a banner ad. So what we did is when I came into what I saw when I came into the space of the financial and the algorithmic trading space, I was amazed to see that while I was expecting everyone to be driving a spaceship, I've discovered that everyone is still driving Excel spreadsheets and beat up old cars. So that's kind of what the dream that I had for TradeLogix kind of started bubbling up about 7-8 years ago when I started working on as a trader. And this is the kind of the culmination of all my wishes and dreams for what a trading platform should look like. And the way I see it, it shouldn't look like a trading platform. It should look like a cloud platform where you have all those different tools that you can build your own stack. And the difference is in the approach. Not sure what happened here, but the difference is in the approach. So as I mentioned, we did not create a trading platform. We created think of AWS. There are lots of different tools that you can build your own customized stack. The reason that we did that is that it was, if we would have built a platform, a trading platform with its own set of tools and its own framework, then it would be working great for one trading style, but wouldn't do the job for other trading styles. The only way to be able to serve different trading styles is to have a platform that has all sorts of different components that you can build your own thing. So we don't have, it's not a trading platform. We don't have a framework, so there's no TraderLogics.buy or TraderLogics.sell or something. There's no black box. These are all completely straightforward API calls, and it's completely agnostic. So we use your own language, your own broker, your own any data source. So seriously, any type of thing that you want. And there's many relationships. So you're not limited in any way, in any time, to have one strategy that trades one broker or one market. So anything that you do, you can have one strategy that shorts Bitcoin, buys equities, hedge using futures, and just do a whole bunch of things within the same strategy, and you will be still getting reports and statistics as one cohesive strategy. So you won't have to go around through different brokers and try to figure out how you're doing. So it's completely customizable, and the best thing about it is the IP protection. One question that keeps popping up every time is that are we able to look at your code? So the short answer is no. Everything that's running on our servers is encrypted and protected, and it's an own isolated environment. However, I understand that a lot of people could say, you know what, I still don't care. I still don't believe you. I don't want you to have access to my code, which is completely fine, which is why you can run your code, your strategy, your logic itself on your own machines. You can get a server on wherever platform provider that you want, but you can still use TraderLogics for everything else. You can still use this for the data. You can still use this for for the reporting, for the APIs, for the execution, for everything other than running your code. So you have this complete freedom, and that's all due to the difference in the approach that that we decided to take. In terms of the roadmap and when you'll be able to start playing around with the platform. So right now, the platform is finally in a ready to display phase. We'll be starting onboarding next week on May the 4th, because we are building a spaceship. So why not pick Star Wars Day for that? And in the upcoming months, these are the things that we are going to add. So we're going to add, we're going to launch the final version, which is right now in beta, of the research environments and the online IDE. We're going to integrate a Coinbase TradeStation, TD Ameritrade, and E-Trade. Later in June, we're going to introduce a portfolio manager application and a pipeline, and as well as integration with Robinhood, Webull, and Schwab, and Fidelity. And in July, it's going to be team accounts, choice of data centers. We're building data centers that are going to be based in Europe and in Japan. That's kind of the first stage of us preparing to serve the global equities as well. FTX, by the way, is already integrated, Charles. Yeah, so that's why it's not listed here. We already have about, I think, 12 brokers, and in the next 2 months we're gonna get over the 20-something mark. In August, we're going to introduce the Algo Studio and allocation managers and US futures. And by allocation manager, by the way, it's a very interesting concept, is a strategy that allocates funds between your strategies. so you can decide automatically on the maximum allowed allocation for your strategies, because you'll be able to build some sort of a fund of funds type of stuff. So yeah. John asks, are we planning on supporting options at some point? Yes, we are. The some point, that's kind of the $60,000 question. But yeah, the main challenge with options is not to provide the actual data feed, but is creating a robust enough backtester to work with this data, since it's you have such a lot of it, and it's just making sure that everything is sorted. My guess is that by the end of the year we'll have support for options, although it could be the start of next year. So that's in terms of options. By the way, if there's any specific broker that offers an API and you want to see, just make sure to tell us about it. We developed our platform in such a way that it's relatively quick for us to add a new broker. So if Andreas, you just mentioned that you want to see Duca's copy, that shouldn't be a problem. If they have an API, this should take us about a week or two to make sure that they're up and running. So it's just a matter of knowing which brokers are in demand, and we'll be able to have them. Obviously, interactive brokers, we already integrate them, and we have Alpaca Markets, and we have BitMEX, and Oanda, and FXCM. So we already have a bunch of brokers already integrated. But the idea is to get to the end of the year with essentially cover all the brokers that people have asked for. So that's our roadmap for this year, and it's going to be very, very exciting. In terms of the pricing, this is another. Do we intend? Yeah, and you know what? That's a very interesting question. And let me go back one slide. So yeah, do you intend to implement a similar tool to Universe Selection as in Quant Connect? So yeah, we call it the pipelines, and that part of what you'll be able to do with the pipelines is to build your own universe, and that universe could be either a fixed universe, so S&P 500, small cap, big cap, European stocks, whatever it may be, or it could be something that's dynamic and based on your own formula. So whenever you refer to Universe Charles, you know that it's going to have, or Universe Laurent, it's going to have the stocks that matches that that universe that Laurent mentioned for the stock for the short squeeze. So it's going to be small cap. It's going to have utilization. It's going to have the RSI. It's going to have everything. So it's going to be kind of a dynamic type of universe. So in terms of the pricing, we have three things that we are going to be charging based on. One is the usage base, so based per action. Now, what is an action? That is kind of the mythological beast that people are keep asking about. What specifically is an action? So an action is any type of interaction that you initiate with the platform. So this includes and only those three things. Every API call that you talk to our servers, any data push. So if you say, please send me pricing information or fundamentals every hour. So every hour when we send you that information, it's going to be counted as an action. And if you want us to monitor your positions or orders or a specific price and alert you for it, so every minute that a monitor is active during market hours is going to be counted as an action. So it's very easy and transparent to see and know what an action is. So that's one thing that we're going to be build based on. Another thing is on volume. So once you go and you start to live trade live markets, then we are going to be charging you based on the total volume that you're moving. And every $100,000 that you're moving, it's on a tiered structure, are going to cost something. So it goes from anywhere between You know what? I can't even remember. So I think it's anywhere between. Let me just see that. I think it's like $8 or something for every $100,000 traded. I think the highest, the most expensive one is, it's $4. Yeah, sorry about that. So it's $4. It's the lowest, and the highest is 20 based on the volume that you're trading. And there's obviously several add-ons. So if you want research environments, or if you want to be in a specific data center, so you're gonna be able to pay for that specific thing. And prices there are very low. If you go to Traderlogics on the pricing page, I'll just do it right here. So if you go to Traderlogics on the pricing page, you'll be able to see our entire pricing schedule, and everything is listed here. The research environments. Cool thing is the GPU ones that we have. It's a kind of monster of beasts that you can play around with. These are coming out next month. So that's currently what our pricing looks like. In terms of, just go back here. In terms of availability, we obviously, there's, as we promised, there's the forever free plan. It's 100,000 actions every month that you're gonna get for free, and you were able to trade $1,000 worth of live trading. There's no credit card required. If you want to get more than that, obviously you have a few options. One is to go to the pay-as-you-go plan, or switch to one of the packages that will allow you to use the number of actions that you need. We try to make the pricing as affordable as possible. If you take a look at the page and see all the things that you're going to get as part of it, hopefully you're going to find it reasonable. If you think we should charge more or less, I'd love to hear your feedback. So please reach out to us and let us know. We're still in the very early stages, and that's any type of feedback would be greatly appreciated. Now, as I mentioned, the platform is up and running right now. If you go to the sign up page on traderlogic.com/offer, you're gonna be able to sign up to any one of our plans, and if you sign up before May the 4th, you're gonna get double the actions on whatever plans that you've selected. Whoops. So if you sign up for the trader, you're gonna get 20 million actions, and you're gonna get $150,000 in live trading, and there's going to be a very one-on-one onboarding call that we're going to do. So that's if you're up for it, if you want to be among the first one who tries it, that's the link you should go to. It's traderlogics.com/offer. And oops, I need to stop moving my cursor that direction. And that's essentially our promise to you, is to make sure that we will be there to do the hand-holding when we are going to schedule the one-on-one call with each and every one. We're going to take the time to make sure that you fully familiarize with the platform and go over the docs and build a simple strategy, but we'll build a strategy together just to make sure that you know how to get all the how to go around the platform. So I really hope and recommend that you take us on this offer. Just as a side note, on May the 4th, this link will be taken down, and we will, in about 2 months from now, we'll open the site again for sign up for everyone. So whoever wants the access right now, that would be a great timing to do so. And yeah, let's time to take some questions. Alec asks, does that apply for upgrades down the road as well? I'm guessing that you're referring to if you pick one offer right now if the upgrade and all the doubles. So yeah, anything you'll do in the next year will be covered as part of as a special 2x type of type of offer that we're doing right now. Let's take another questions from Black Arbs. Are continuous features available on the platform? So yeah, that's if I'll go back to the roadmap. Continuous features are going to be coming to the platform on August, probably sooner, but I'm not committing to anything after than August. So that's in terms of the fewest futures, and they're going to be in continuous futures. So you'll be able to trade using ES1 or ES2 or a VX1 or VX2 instead of mentioning specifically the contract that you're looking for. So it's going to be easier for backtesting and for live trading. Let's see another question here. I have an extremely Gomez. All right. I have an extreme profitable system. How can we ensure the rules and logic is protected? I encrypted at rest. So yeah, everything that we have on our platform is encrypted. So the database is encrypted at rest. Encrypted at rest, by the way, if you don't know what it means, it means that the data itself is encrypted. Not just only that the transfer of the data is encrypted, but it's actually being stored encrypted. So that's what we do. We actually had to develop our own type of stuff to make sure that the strategies would be able to run from an encrypted state. Be that, I mean, having said that, you can still opt in if that makes you feel more protected. You can still opt in to run your strategies on your own machines and use us for everything else. Hopefully, I'm hoping that you won't. I think the experience would be a lot smoother, and a lot easier for you to work with if everything happens on our own servers. But you can still have full control over where to host and where to run your strategy from. Let's see another questions. Alex has, who controls the encryption keys? And the follow-up question is it possible to bring my own AWS key? So right now we don't have a way to import your AWS key, but you will be able to create your own keys on the platform and just import it there. This is definitely a feature that is worth looking into. If you already have infrastructure on AWS, then we can definitely take a look and see what is involved in making sure in being able to support that. But right now, this is not an option, sadly. So Joseph asks, are there enough retail algo traders for this to be successful? So yeah, here's the amazing part, and this is actually a fact that may surprise most of you. So currently, if we're looking at the kind of retail algo trader and the lower tier professional algo trader, so if we're looking at this type of group, there are currently about 50 million people who answer to this profile around the world. That may not sound like a lot if you compare it to 9 billion or whatever, but it is a huge market. So that's where, not including funds, not including all sorts of people are doing it on a professional level. Just people, I'm guessing, much in the same profile that you've mentioned. So hopefully we're counting on the market to be large enough, and we're counting on the market to be in a phase where they would actually benefit a lot from a product and from a platform that really allows them to focus on what it is that's important to them, which is coming up with trading ideas and trading signals instead of handling the IT part of things. So that's what we're doing right now. Yeah, let's see. So Alec asks, Is it possible to have reports directly sent to a third party? Actually, no, but that's a feature we can have in a week. That's seriously not, yeah, that's seriously not a very hard to do feature. So let me just make sure that I write it down. And yeah, we'll make it so it's actually very simple for us to do. We do have plans, by the way, that as soon as in May, you're going to have an option to publish your tear sheets, your strategies tear sheet on a public page or protected by a password, and that you can share that. But if you also want to send it, that's definitely something that we can add. That's not going to be a problem. Let me see if I've missed any specific questions. Oh yeah, sorry, I missed that question. Yeah, so the question was, you got stuck in a meeting. Can we start using it? Yeah, definitely. So as I mentioned, you can go and sign up on tradeologics.com/offer and just take control, subscribe to your account and start using this. Yeah, okay. I'm guessing that this question kind of relates to what happened with Quintopian. It's kind of my guess. But before I'll answer this, let me just bring up Laurent and really, Laurent, I'm kind of keeping you around instead of letting you go back to sleep. So I really want to thank you for your time today. I really do appreciate it. You know, as always, you're the man. You've always been the man. So here you are. Thank you very much for your time, and I look forward for our next part.
Thank you very much, and thank you very much for this webinar, guys. Sign up. I mean, my belief about Tradologics is everybody wants to play video game, and so far the algorithmic space is you can only do it if you build your own Apple One. And what Tradologic does is like take care of all the stuff you don't want to do, so you can concentrate on your $1 billion idea that is going to torpedo your account in the next 3 weeks. Thank you very much.
Thank you, man.
So, Ran, thank you very much for the work you're doing. You're really, really helping the community. So thank you very much. And thank you all. And have a good day or night, or it's 5 o'clock somewhere. Thank you.
Yeah, it's 5 o'clock.
Bye-bye. Signing off.
Enjoy your wine. Have a good vacation. Talk soon. Cheers. All right. Let me cover a few of the questions that remain here. Yeah, so that question from Alec again, commit to open source. Yeah, so what happened is in last November, Quintopian shut down, and they gave everyone about 2 weeks notice to get their strategies, and if they didn't, then everything would essentially, you're going to lose access to everything. So we are working on full integration into, by the way, we already have version control of everything that we do in the strategies, and you can keep a record of your entire trading history and your strategies history. But we're also going to introduce a sync into a common repository, so you'll be able to sync your strategies into GitHub or Bitbucket or whatever it may be, and just get it. Make sure that you use that as your essentially code repository and push it from there to Tradologics. So hopefully that will take care of making sure that you don't lose your code. And yeah, we have no plans on shutting down or abandoning it, but I completely understand. All right, let's see. S3, what's S3? That's I'm not sure what this is referring to, S3. Let's see if I missed anything. All right. So if you have any more questions, feel free to shoot us an email to feedback@tradeologics.com. We'll get to your emails and make sure that we respond as soon as possible. So if we missed anything here, we'll definitely make sure to get back to you as soon as possible. All right. So I want to thank you very much for attending this webinar. I'm going to stick around and kind of answer very specific questions that people have. I'm going to answer them on the chat. But yeah, please go over traderlogic.com/offer. And I'm really looking forward to seeing you inside and see what you're going to build next. Thank you very much. See you soon. Bye-bye, guys.